So we've had a couple of conversations around the ownership economy, and we started off with Kia telling us about retirement planning. Then we went to Agu telling us about the macroeconomic outlook. Then Dr. Karosisi told us about us not having a problem with growth, but more ownership. So we want to dive a little bit deeper into that, setting the foundations for the ownership economy. And I think a good place to start, and I'll start with you, Mwati, is there are sometimes structural gaps when it comes to building our portfolio. So I'd like you to mention what are some of those structural gaps that exist, and then we can dive deeper on how we can overcome them.
Thank you for the question. When you look at structural gaps, which is actually quite a wide term, the things that come to mind are, it could be information, for one. And I say that's a structural gap because markets really trade on the idea of perfect information, that everyone has as much information as everyone else. Now, what you find in markets like Kenya is there is an asymmetry of information. And that's to say that not everyone is reading the business press. Not everyone has access to good meeting information. Now, the way some of those infrastructural gaps are closed is by firms like ours who run, say, for example, let's take an equity fund. We do have an equity fund. In there, you'd find there's someone whose job is to basically talk to management at companies, understand what's going on, look at annual reports, look at financial reports, just have an ear to the ground. And that solves that information asymmetry, because if you put money into that fund, you basically are entrusting it with someone whose job is to basically be on top of information. So I think as we grow this unit trusts, then we'll basically solve a lot of those structural gaps that you find. The other things that could be structural gaps could be potentially regulation, I would say. However, that is getting better. It's getting easier. We're seeing that government is going to privatize companies. You know, for a long time, this was something that was lacking in this market. What it does, it will be a catalytic event. We saw this in the Middle Eastern markets, for example. If you look at the Saudi market, when they wanted to get it going, they listed Aramco, which is the large oil company. Same thing in Dubai, in UAE. You've had Dubai Taxi, you've had Salik, which does the toll roads. So basically the state, once it starts to privatize good companies, then what you get is the capital markets also start to move. And that's solving another gap. And I think those really are, and perhaps another structural gap, maybe if you allow me, it's maybe a bit of a stretch, but perhaps the idea that investing is expensive or investing is for rich people. I don't know how you would classify that. Maybe that's a mental structural gap, or it's a lack of accessibility to information. You know, I think it really couldn't be further from the truth. You know, right now in the market, there are products that allow you to do this for 100 shillings, for 1,000 shillings. So access is available. I think maybe the industry just needs to make sure that people understand more, which is perhaps, again, the big structural gap. So hopefully those are some of the things that came to mind.
Thanks for that, Mwati. And you've talked about that lack of access to information, and that ties closely with that so-called mental gap. But Nicholas, I'd like you to dive deeper, because that's one of the reasons we're here in this forum, because we want to understand how can we build long-term wealth. So what would you say are some of the funds that could help support that growth?
Thank you. I think in terms of building long-term wealth, one should seek investments that offer three things. One, capital preservation. Two, inflation protection. Three, compounding. There are various assets or structures and funds that people can invest in that offer this. We have retirement benefit schemes. They are a source of long-term wealth creation. They are the cornerstone, actually, of wealth creation in many economies. Because what happens is that these retirement benefit schemes allow long-term investments to tie to long-term liabilities. Yeah? and we have regulators who manage this. We have equity funds, both local and global. Even in periods of volatility, we tend to see equity funds perform very well over the long term, yeah? Because they beat those periods of volatility to deliver superior returns, yeah? Globally, we have many funds that people can invest in. Locally, we also have equity funds, which are structured. And if I was just to give an example, in our market today, the NSC in Kenya has already delivered over 50%. Leave alone last year, where it delivered more than 30% return. So those are some of the funds that investors can get into that would offer real returns and superior returns. We have balanced funds, and how those work is that they basically don't give you the full exposure to equities, but they give you exposure to a mix of equities and fixed income. Those are available in regulated entities in Kenya and even globally. We have alternative investments as well, private equity and venture capital funds. Those are emerging asset classes that are taking shape, especially in East Africa. Those are some of the investments that investors can get into. And then you have your typical multi-market funds that offer capital preservation, because the assets that are invested there basically are meant to offer the lowest risk possible. Thank you.
Thank you for that. So we're talking about capital preservation, we're talking about beating inflation, and then we compound what we have. Now, Stephen, the digital ecosystem is very important, and we cannot ignore the role that it's playing. So from where you sit, I'd like you to tell us how we can use digital tools to make sure that we're moving from transactions to the ownership economy.
Yeah, and thanks. And perhaps where I'd want to begin is from where Nicholas has taken us to. And the reason why I believe it's important to begin there, and I'll start with a question to the audience, right? How many people understand what equity funds are in the room? Well, that's discouraging. And the reason why I'm saying it's important to start from that particular point is because I think perhaps the reason why we are not able to make long-term investments is because perhaps we don't understand, right? I think the reason why we don't understand is because most people believe it's complex. We are using technical terms to try and communicate what this is all about. And I think that is where digital comes in, right? And digital comes in as an enabler. I don't think digital provides solutions, but digital only plays the part on being able to distribute and enable solutions for individuals. And to that sense, then, there are three things we must simplify. The key word then is we have got to simplify how individuals invest, right? There are three things we've got to simplify. We've got to simplify the how. How do people invest today, right? Is it complex? What are the requirements for investment from a KYC perspective, etc., etc.? And I think that simplification is the first step to enable individuals begin to invest. The second piece of how of simplification is the what, which speaks to the question around what are these actually? Because I don't think most people understand what these things are. They're a bit more complex, and therefore we need to package it differently. I think digital will play a very big role in terms of educating individuals. For example, today, how many banks in their applications just have a how-to, right? Or like an FAQ around investments, or a robot that just comes in and you are able to answer questions, that is able to answer questions specifically around investments products in Kenya, for example, right? Be it things like chatbots, for example. So I think that's really the real effect digital begins to bring, right? And as Absa, we're really working towards providing such simplistic solutions that are then able to demystify what these assets are as they were, and how they are, what benefit they give to our customers, and then beyond that, how can they help you develop long-term wealth?
Okay, so digital is an enabler, and we are talking about simplification of all of these things. Now, we've talked about balanced funds, equity funds, but real estate, that is an area where people don't always understand how to make the most out of it when it comes to long-term creation. So, Anthony, you know, for very many people, the only thing they think about when it comes to real estate is maguta, maguta. You get a plot here, another one there, but there's so much more to understanding real estate when it comes to wealth creation. So take us through how real estate can really be a tool for wealth creation in the long term.
So thank you, Claire. I think if you look at real estate, you from an investor positioning, I think what you really need to think as an investor is first the purpose of what you're picking, because the use, most of the market, we concentrate on maybe you're just buying for use. You can buy for rental basis. You can buy for holding purposes. So once you're able to map out what is the use, then you're able to then position your real estate investment accordingly. Because depending on the use, there are factors that you then take into consideration. In the current market, there are very innovative financial structures. So when you think of real estate as a home ownership, then how about affordability? When you're selecting that asset, do you want to know your range of what you want to invest? Then once you know the range, you then need to plan your cash flow so that the asset that you then pick aligns to your cash flow. And with that cash flow thought process, then it brings to then exploring what are then the flexible options of coming and owning that. You see a lot of developers currently are offering flexible payment plans if maybe someone is picking a residential asset. We are seeing a lot of creativity around the market, especially in the coming year. We'll see investors introducing D-rates in the market, where you can actually invest at the onset with an institutional developer, and then you are able to enjoy that upside. We are seeing a lot of creativity. Maybe one of our subsidiary at Centum called Triffic, Two Rivers International Financial Center, which is an SCZ-backed entity, will be positioning a dollar I-rate in the market next year. What does that mean? When it's an I-rate, then it brings that ability to even fraction real estate to tunes of even $1,000, you know? Not where we thought that you still need to buy a plot, hold on it, and then flip. If you buy or invest a structure like that, the I-rate gives you recurrent income. There's dividend. This is something that even if, in terms of even liquidation, even if you wanted to then convert this asset to money, the exit strategy is clear. So long-term positioning of real estate is purely based on the personal assessment of what you want, and you always have to assess your portfolio. We always advise that you have a balanced portfolio, such that if you look at most of the richest guys worldwide, you'll notice real estate as a portfolio occupies between 20 to 40% of the asset. But part of that, almost 30%, is liquid. It's something that is earning cash flow. So we have really progressed. There are structures. Real estate is not as rigid as before. There's a lot of competition. There's affordability. You can pick assets that almost are equal to, you know, whatever used to be a plot, but are giving you recurrent income. You can blend that with assets that you're holding for ownership purposes to develop in future. But for those assets that you then pick to hold, you then need to think about the location, the infrastructure around those, and the growth potentials. you need to do a bit of research. Think if I'm buying a plot to speculate, is there a planned government projects on that side? Is there infrastructure plans? There's a lot of digital information currently. You do a bit of research. So by the time you're placing something, even if you want to exit in future, you have already grown it. And even if you want to pass it to the next generation, you have already picked a very strategic asset that will give you proper ownership and even grow your portfolio in the long term.
Okay, so you really need to understand what are your individual goals, and then now you can move from there. And there's so many exciting solutions in the market. But Mwathi, I want to come back to you. We talked about that lack of access to information. And for many retail investors, they sometimes think, okay, there's so much there in the market for me, but how can we ease access to this information to make it easier for them to enter the market so that they can grow their wealth?
Thank you for that. Perhaps maybe I give an example of a market where information is driven by Reddit gangs. You know, like if you look at the US and meme stocks, you know that is kind of really the pure essence of where information, whether real or not, is available to everyone and everyone is making investment decisions. So I think in Kenya, what you've seen is a very, very big increase in the amount of information that's available. I mean, the sponsor of this platform, the person who's invited us, is part of that revolution. There are others as well. So if you go on X right now, you'll find 1 million people in Kenya who will have an opinion about something. I think that is really the way information starts to be disseminated. And then, you know, eventually the quality names rise to the top, and then the gossip stuff. But gossip is not bad. I mean, gossip in a market is good. And I'll tell you, because it creates volatility. And volatility is an up and down. You know, to Rafael, my colleague, earlier talking about the Kenya shilling, which was quite flat, volatility would be the opposite. It's up and down. And the reason people trade US stocks, for example, is because they're volatile. You know, NVIDIA could be up 10%, add more market cap in the GDP of Kenya, and then the next day could be down and, you know, take down, you know, lose a couple of $100 billion. That's volatility, because it means that you can take a view on the downside or the upside or the upside or the downside. So I think what we are witnessing in Kenya is actually really amazing. Information is out there. People are talking about money market funds. I mean, even your grandmother now probably knows about a money market fund. It's amazing, isn't it? Everyone says, what's your rate? Is that the first question that comes? So that's basically showing that people are realizing that there are investment products. People perhaps are not so sophisticated yet. And to my fellow panelists' point here about information, what's an equity fund? I understand what an equity fund. We run an equity fund, but perhaps we're not doing a very good job of explaining what an equity fund is. But an equity fund, I'll tell you, is a fund where you put some money in, it takes that money and goes, and there's an investment committee, so a group of professionals whose job is to understand the market, listen to what's going on, think about the risks and the opportunities, and they come up with a portfolio. It's the same way you might think about your store. You know, how many, you know, how much sugar do you need? How much salt do you need? How much flour do you need? How much oil do you need? And how many luxuries you might need? So that chocolate or something that's expensive or a treat for the kids or something. It's the same way that someone running an equity portfolio would think. So is it this bank? Is it this consumer company? Is it this cement company? What do we like? What do we not like? Do we like it long term? You know, like you're looking at your pack of unga, what's the sell-by date? It's the same way you would think and say, when do you think I would be able to realize that investment? When, is it long-term? Is it short-term? Is it a canned good, so it has a really long shelf life? Or is it something like a fruit and vegetable, which will last you a week or so? And so you put all of that together, and basically you have a portfolio. Maybe it's 20 names, maybe it's 30 names, maybe it's more. And that is optimized to give a return. That's what an equity fund does. It sorts out you having to go and buy 30 different stocks in your name. You may have 10,000 shillings or even 1,000 shillings. There's no way you can sit there and buy 30 stocks with 1,000 shillings. It's almost impossible. But through an equity fund, you can. So you get diversification, so you spread your risk. So that's kind of what we do. And so the information is getting better out there. You know, if your grandmother knows about a money market fund, which is easy to understand because it's about an interest rate, maybe soon she'll be asking you about, so are you in the NCBA equity fund or are you in the CIC equity fund? You know, which one is got a better return, you know? And that's a discourse that we want and the competition we want, because we're all in this together. If the capital markets grow, if you have liquid wealth, if real estate investment trusts grow, if there's more information and people are saying, so now is the terrific one, for example, it's nice dollar yield, for example, or maybe it'll be something else somewhere else. Maybe it's Acorn, for example, which is student housing. And you start being able to make choices. And choice is empowerment. I think someone won a Nobel Prize for that, actually, an economic prize, Amartya Sen, in the past. So I think information is there. The walls are being broken down. You'll find it on X, you'll find it on Facebook. I went to a market recently, just as a close, Ethiopia. Ethiopia is interesting because they trade stocks on Facebook Marketplace. Now they have a stock exchange, the ESX. But before that came to place, people were trading on Facebook and information, there were brokers, etc. So I think we're really in a very great sort of inflection point. The information is out there, it's available. Read it, trust it, not trust it, but read it. The most important thing is to read it and then decide whether you think it's nonsense or it's accurate. And us, as the investment professionals, our job is to decipher that through products. So what we'll do is we'll make it easy for you. You don't have to sit there and read the Business Daily or the Economist or the FT. All you basically have to trust is that Mwadi at NCBA has your best interest at heart and will try and get you the maximum return for the lowest possible risk.
Thank you for that. And I like that analogy, the way you just simplified what an equity fund is. But Nicholas, many times we don't have that in the market. You hear all these terms, we've heard about that USDI rate, so many things. So now how can asset managers really go about simplifying very complex investment decisions so that people are not giving the excuse that I don't understand it and that's why they're not investing and building their portfolios?
Thank you, Claire. I think I'll build up from what Mwathi said in terms of how he explained an equity fund. It's basically fractional ownership, and as well as an income rate. One of my co-panelists mentions about rate is fractional ownership, because we all know in real estate, because of high unit value, that's one of the barriers to entry if you go in as an individual. As asset managers, I think one of the things we need to do, keep doing rather, is simplifying the jargon that we use about some of the funds that we manage. So for example, in our financial markets, we use jargon such as yields, duration, risk-adjusted returns. That is not something you can explain or the common layman needs to know. I think what we need to do is to move from that and explain to a client that you're getting into an equity fund based on this goal, goal-based investing for the long term. If you're getting into a money market fund, maybe you have some money you're saving for school fees, for retirement, for purchase of a house, for any other future long-term objectives or goals that you may have as an individual. So it's basically to break down that jargon into what the client can understand, basically explain to them, if you're getting into an equity fund, this is the risk that you're getting into. This is the potential return. If you're getting into a money market fund, money market funds have increasingly become popular. The risk is X amount, the potential return is X amount. Thank you.
Okay, so just breaking it down into bite-sized pieces. Now, Anthony, let's go back to the issue. Actually, let me go to Stephen first, back to that issue of the digital economy. Now, you said it's an enabler. Now, I'd like us to double down on some of the actual tools that are proving useful when it comes to saving, investing, and then protecting wealth. Could you give us some examples?
Yeah, thanks. It's a good question. Look, I think if you look at tools which are effective, there are a couple of things that have got to come to mind. And for me, the first thing that comes to mind is that he's got to be inclusive, right? And to my earlier point, I think if you don't have tools which every single person can use to invest, already we shall have failed, right? How is it that my cousin in the village is able to invest in these things, right? So I think that inclusion becomes a very important aspect of it. The other bit that then comes to my mind is the transparency bit, that all the information is available as the customer makes the decision using the tools, right? And therefore, things like rates, what my colleagues have talked about, things like what is it really about, right? So that transparency has to be there, right, fully. And I think also it's very important that it actually just works, right? Because I think most of the tools that we have today don't work as per customers' expectations. Now, when I think about a tool which meets that kind of criteria, then things like the investments tools around M-Pesa come to mind, right? And so you look at products such as what is being offered within M-Pesa, from an investment perspective, right? You look at tools which have shifted beyond M-Pesa to tools like Timiza, which is being offered by APSA, tools like Loop, which is being offered by NCBA, right? Those ones are almost beginning to tick that box, from an access perspective, from an information availability perspective, etc., and even from a transparency perspective. And so I think the role of digital then becomes ever more elevated in terms of being able to provide that sort of inclusivity, i.e. be able to reach everybody and anybody in the country. That's number one. And number two is that because we are then able to demystify information better, we can even have how-to videos within the application. It becomes very easy there for customers to understand what are the rates applicable, what is the nature of the product, for example, what is the risk that I'm getting into, for example. It becomes very easy to demystify that kind of information. And therefore, lastly, as long as digital works, then we have a place to then begin to really, from a tools perspective, to truly begin to distribute some of these assets that we have.
Okay, indeed, like the how-to videos are very helpful. I'm sure everybody in this room has been to YouTube. You get stuck in something and you just get the answers, and that's very applicable, especially like tax and whatnot. Now, Anthony, you spoke about rates, that fractional ownership. That's really helping people get into this ownership economy. But other than that, in the real estate sector, what other tools are being used to ensure that more people join that ownership economy?
I think from our sector, the key thing we are looking at in terms of encouraging ownership in the market, one of the things that each and every developer is currently exploring is accessibility, first to the sector, and this accessibility has to be anchored with affordability. You'll notice currently, as you explore our market, 90% of the market is renting. Yeah, that's quite an amazing statistics. In fact, with all this development and all these assets that you see people advertising, it's only about 10% of the market that buys these assets, then puts them back to the market for rental. So what we have been struggling as developers is how do we then transition? Because remember, if we are all concentrating on the 10%, the bigger cake is on the 90%. So you will see moving forward a lot of us then coming up with very interesting structure. People are exploring now rent-to-own model, where we need to come and collaborate with NCBA, with ABSA, with other financial structure, long-term capital. Then this long-term capital is then, we are able then to transfer this asset to people such that the amount you contribute as rent contributes to part of your home ownership. Because it will be really hard to continue then serving this 10%. At one point it will dry. We need to be creative, yeah? Then we are also looking at a lot of digitalization in real estate. This means nowadays, as we build our product, we have to think about the end user. And when we think of the end user, we are thinking of how do you reduce their utility bills. All of us, even where we are seated, is a real estate asset. You are either working in a real estate, you are sleeping in a real estate, you are interacting in a real estate setup. Then how do you make those setups very efficient to run operation-wise? So you see a lot of developers now talking about sustainability. These standards that most of the developers have adopted, like the EDGE tools by the World Bank, where, for example, in Centum, our objective is almost to reduce your 1 month utility bill by just investing in our asset or living within our asset. We'll check every element. How do you make your room have better lighting? How do you reduce your water consumption? You know, these innovative technologies then help to input. Then you also have to think about tools around encouraging the livability. In fact, nowadays, our parameters when we are rating an asset, we always ask ourselves, how TikTokable or Instagrammable is this place? Because one of the interesting bits, and it's something you adopt, you are living in the age of Gen Zs. If you visited our Two Rivers development on a Wednesday afternoon, there's so many youths shooting YouTube videos, TikTok videos. Now, this is the future. So when you're setting your ecosystem, you then have to think, how will people enjoy living in this? So you think if you're hosting your residential setup or commercial setup, how is the estate management element? Do you have tools that you have then adopted to that ecosystem such that you can sit here and you can monitor how you are consuming power in your house? If you have an issue, you just need to maybe drop a text on a platform and that integration comes up there. So these elements, it's not the traditional real estate. It's becoming now people-centered. And the more people-centered you are, the more then the market will even appreciate what you're doing. Eh? So these are some of the initiatives that we are doing. And most importantly, what developers now really need to think is how to support secondary market. Because most of the time, someone will sell you an asset, but are they thinking if one day you want to liquidate that asset, how quickly can you get money? Yeah, you've come, I've sold your house, maybe within Two Rivers, but maybe 4 or 5 years, you need the cash. Do you then really struggle to sell this asset? So that secondary market support and liquidity planning, I think it's important, and it's anchored around developing assets that are sustainable, making sure that apart from selling assets to people, there's proper support around maintaining the asset, partnering with institutional investors and financiers like ABSA, NCBA, or investment bank, such that we can do matching. People can do asset equity release, and you're able to do the advice between, your investor and the bank, arrange those matrices, give them advice. So I think as we check this, we'll make the real estate more supportive. It's the backbone of the market, of the economy, considering right now in a market like ours, a GDP of 16 trillion, real estate is almost participating 11%. almost 1.8 trillion. So we need to make it liquid. We need to make sure that all these tools are anchored to supporting liquidity, livability, and the whole ecosystem working smoothly, just like any other liquid investment.
Very interesting points you put there. And you know, when you say things like TikTokable place, it just speaks to strategy. So during this final round, I want us to talk a little bit about being strategic when we are building our ownership. And Mwati, I'll start with you. What are some of the tips you would give to people as they move from just ad hoc investing? How can they be strategic as they grow their wealth?
You know, one of the things about investing is you need to work out where the tax breaks are. You have to be strategic that way. So if a pension gives you a tax break, perhaps at the end of your professional career, then you need to take it. I mean, I've lived in other countries where, for example, I lived in the UK for a long time. And in the UK, they have something called an individual savings account, an ISA. There are two types of ISA. There's a cash ISA, which would invest in money market funds, and then an investment ISA, which you would put in a bond fund or you'd put in an equity fund, for example. Now, it is the only tax break that you will get from His Majesty's government. So the first thing you do is you take up your allowance, whether it's the maximum amount or whatever you can afford, and every year you would just add up and you would just add up and you keep saving, because when you sold it at any point, when you wanted to liquidate, you could sell out tax-free. Now, in a country where the top tax rate was almost 50%, that is a very, very significant difference. So I think you have to be strategic with tax planning. I know it seems boring, but really it's really efficient. So for example, if you have a corporate and you put money in a fixed income fund or a money market fund, the withholding tax is a final tax, so it's just 15%, as opposed to paying another additional 15% to get to 30% corporate tax. So there are ways to think about it. So be smart with your money. Talk to whoever your advisor is and say, okay, let's start with taxation. What's the smart thing for me to do? What insulates me now and what protects me later? Then the next thing is, I think the question of trusts came up, and the one advantage of trusts is that they don't go through probate. For those who know what probate is the process of when someone dies and you have to go get letters of administration and gazette it, and it takes forever. There are many families that are in the paper that have been going through this for tens of years. If you're in a trust, it does not go to probate. So it moves immediately to who the beneficiaries are. That is a huge advantage, whether you're saving 100 shillings or 100 million shillings. Whatever your assets are, you have to think about it. So that's another strategy. Then the next thing is, I think you have to think about, are you saving for something? Do you want to buy a car? Do you want to buy a house? Is it school fees? Is it just putting money aside? And then the next question is, how we in our world would say liquid, but actually perhaps the best way to explain is how easy is it to access that money? So I'll give, is it money that you can write or on your app, go and say, liquidate 100,000 of my NCBA fixed income fund? Or is it something where maybe you have to wait 6 months or a year before you can have access to that money? Is it a real estate project, which maybe takes longer, years to sort of, get through the whole process of doing it? So you really have to think about how accessible do you want this money? If it's for school fees, then I would suggest that it's pretty accessible. If it's for retirement, if it's for saving up for building a house, then maybe that money needs to sit in an account for a lot longer. So I think these are the strategic things you have to think about. They're boring, some of them. And I think the other thing we never think about in Kenya is a reputation of where you're keeping your money. That is extremely important. And in fact, arguably, I would say, should trump the return that you're expecting to get. I always tell people, unless you have an oil well in your backyard, some returns are perhaps a little bit too generous. So just ask yourself. So be strategic in your mind. Just ask yourself, does that really make sense? You know, the bank is offering me 7% for a fixed deposit. Someone's offering me a return of 80%. Is that possible? How does that number come? So just get an envelope and just jot those things down. Just be a little bit disciplined. Go to ChatGPT. Write the question. Does this investment make sense? You know what? Maybe it would tell you it doesn't make sense. But at least then you'll have like some way to like investigate. So really think about the reputation of where you put your money. I find we're very safe or careful with the banks where we put our money. But when it comes to our investments, people are not so careful. So please be careful. I don't need to tell you about disasters. You just can find them in any newspaper of what's happened if you're caught on the wrong side. So thank you.
Thank you for that. So tax planning is very important, not evasion, but planning. And as you said, you can always go to ChatGPT. It can give you an answer too. But Nicholas, as we're talking about strategy, let's talk a little bit about special funds, because we've talked about the others. Explain to us a little bit what those are and how we can strategically use them to build and accelerate our ownership journey.
Thank you, Claire. Special funds are basically structured funds that invest in diversified financial assets, and they are a bit more complex than your traditional asset classes. Right now, there are offerings of special funds that, and I think some of my co-panelists talked about access to some of these funds. They have, there are increasingly more special funds coming to the market with less unit value. What does that mean? It makes it possible for an investor, possibly with a little as, if it's in USD terms, $100 or $1,000, to get into a special fund, as opposed to go directly and invest in yourself. And I think basically the reason why Matthew is talking about coming to a trusted partner is because of comparison. If, for example, a structured special fund is investing in a certain basket of assets, yeah, and maybe they are very risky assets, then you typically expect that the returns on that will be high and competitive across special funds. But for example, if you are to come into a money market fund, which is pegged against, a benchmark central bank rate or the benchmark T-bill rate or whatever short-term instrument that they are pegged against these money market funds. And an institution maybe is offering you, 7% to 10%, whereas another institution is offering you, north of 18% in a money market fund. It's only right you ask yourself, even before you go to ChatGPT, where are these people putting their money? Yeah, and I think that just speaks to reputation. Structured funds are good. They give you access to diversified investments away from your traditional investments. But then again, you have to determine why you're getting into this. Before you get into a structured fund, have your base, as Matthew said, have your strategy. What are you investing for? What is your goal, first of all? So that based off that, as you speak with your financial advisors out there, you can be able to allocate your income or your sources of income appropriately to the various instruments that would offer you capital preservation, compounding, and inflation protection. Thank you.
Okay, so really know your why. And Stephen, I'd like us now to talk about digital innovation, and I want you to give us some practical ways that ABSA has used it to expand access for people when it comes to ownership. What has the experience been?
Yeah, it's a good question, but I think it's a question which probably is in all of our minds, and I'd like Nicholas to clarify for us very quickly. Is Forex an investment? Well, I should know it, right? I know we've all been wondering that thing silently in our minds. Is Forex an investment? But look, to your question and the role of new tech and digital and what we're doing even at ABSA, I hold a very controversial sort of opinion that humans are intrinsically very lazy. And whatever you can do to celebrate that laziness wins, right? And I say that because if you look at the innovations and the trends which have come in lately, the likes of things like Uber, the likes of things like Airbnb, they've actually just made things easier for human, right? They have to do less, right? And they can do it where they are. And I think then the role of technology in celebrating that laziness has been quite fundamental. And I think for me, on that basis, what comes to mind is how do we embrace digital and technology by at the same time humanize? Because that's critical, right? Because all these things we are doing it for human. So fundamentally, it's important to understand what humans really desire and therefore begin to make technology and digital work towards that. And so one of the questions that I receive a lot of times is, where is investment and banking moving to with the new age in AI, etc., etc. I think we must not look at AI as a competitor, etc., etc. We have to look at it as a companion or even a partner. And so when I talk about humanizing as we digitize, one of the things that comes to my mind is that, what this new technology and things like AI are going to help us do is they're going to help understand our customers better. And to an extent, they're going to help us understand what our customers require even before they ask us of it, right? So Nicholas here will know that, okay, now I can see Steve nowadays receives more funds. Then he can begin to propose products and propositions which speak to where can Steve invest, right? So I think the role of new technology then becomes to work hand in hand with human behavior to give us better predictions and understanding of what humans would want even before they know it. And they are offer the right kind of products and propositions. And that's what we're trying to embrace at ABSA as we move along. Thanks.
Okay, thank you so much for that. And finally, Anthony, as Stephen has said, now that we're dealing with intrinsically lazy people, what are some of the structural developments and payment options that can celebrate that laziness and make things easier when it comes to ownership within the real estate sector?
So thank you. So from a real estate perspective, I think we have not been left behind. So, for example, one of the biggest pain points we have faced with our investors is mostly the sales process. So what we are currently working on is digitalizing it, such that you can identify an asset. Then there's a proper ownership digital platform where you'll be able to even access your letter of offer, review it, leave comments, send it back to us, such that you don't really, as much as you're coming to confirm, especially if there's a pre-sale asset and you like it, you can actually complete your process remotely. Yeah? And the only thing you'll come to do is just come and interact with us. Yeah? Then number two, one of the pain points, I think this is more to the favor of the developer. The biggest pain point we have had is the development cycle. The development cycle is, for example, in real estate, before you even recognize revenue for what you have sold, you need to have built the asset, handed over to the owner, they sign off, and that's the only time IFRS would allow you to put that in your profitability. So one of the things we have been struggling is how can you then reduce this development cycle? Because for a company maybe to be able to recognize your revenue year on year, it means the stock that you are revolving each year. So that's where technology has applied. You'll find that people are exploring a lot of alternative building technology in the market. There's a lot of now adaptation of formwork construction where developers can be able to build faster. We are looking at materials. Generically, you could see places Flooring is always tiles. Now there are materials like that have come in the market where you don't even need to do a lot of work to finish an asset. This will also be good for the end users, because it means if you have acquired a real estate asset and you want to improve it, it will not be a lot of headache. Those things can be easily removed and replaced back. Then we had spoken about on the innovation around the financing, the various tools. And now developers, because of competition, we have been really forced to offer very flexible payment plans. So we really have to be very creative on where we are sourcing our funds. Because if you have very expensive finance, it means then you're not able to pass this very flexible payment plan to your investors. Because what people are requesting is payment plans of even between 24 to 36 months. So it means then you have to have that breadth to be able to then pass those so that people can pay the asset periodically until the ownership comes that. If then you are not able to do that, then you have to have proper collaborations with the financial institutions, including banks, SACCOs, whereby if an asset is ready, they can then offtake the receivable from your books, and then they are left with the homeowner. But on condition that then the financing option they're also giving the homeowner is very flexible, which a tool like what KMRC is doing in our market, where they have availed single-digit mortgages, has really helped that uptake of home ownership, and we might see even more mortgages now converting, unlike the way we had very few mortgages in the market. So these are the innovations that we are looking. There's a lot of opportunities. We keep exploring, and we are looking at investment, asset managers, financiers, to see how we can restructure real estate so that it's extremely accessible and everybody can easily uptake it.
Okay, so digitization is playing a good role when making everything a lot more easier. Now, I'd like us to get a few parting shots, and this is how we'll do it. I'll ask all of you a question that are practical questions that people will be having in their mind, and you'll just give us a brief answer, and I'll start with you, Mwati. So probably there's a 35-year-old person around in this room who is wanting to build a portfolio of 100 million by the time they're 50. So what will that journey look like to get to that amount?
I want to be that person. You know what? I think it's a very good question. You have to start early. Unfortunately, some of us might be past that. There was someone who came to sell me insurance for, I think it was education policy. And I said, the problem is you're selling me a 15-year plan which matures when my children are well past. So then I told him, you should have caught me when I was 21 and started working. And then I would have put like 1,000 shillings. And then as my income grew, I would have added more. So I think we basically need to start this journey quite methodically, quite early. But it's easier said than done. You can sit here and say, oh, I wish I did, and this and that. I think it's just some discipline. So maybe 100 million might not be the full number. But in the end, I think you have to have a stretch goal. You have to have a number that is meaningful, and to do that, you basically have to just start putting money aside as quickly as possible, and then put it into something that protects you from inflation and is relatively not. Volatility is not bad in the sense that it means you can make lots of money, but in a sense, just put it in a smart place with a smart institution that has your back.
Thank you for that. Now, Nicholas, we've been having these conversations, and we don't want to come here and then leave and do nothing about it. So we're moving towards the ownership economy. And Abojani, we say that we must take action. So for everyone who is in the room today, what is that one investment action they must do before this year ends to move towards that ownership economy?
Thank you, Claire. The answer doesn't change. Start early. As Mwati has said, so before the end of 2025, irrespective of whether you're 35, 20, 50, have a standard savings amount per month. Start with your typical money market funds. They are very easy to understand before you even delve into other funds which are more complex. You leave that technical bit to the experts, the likes of CIC, NCBA, etc., and ABSA as well. Let us help you on that journey. Start saving now. Ownership doesn't start with big steps. It starts with small steps. Thank you.
Thank you. Small steps make big journeys. Now, Stephen, when it comes to 2026, when it comes to the tech sector, what are some of the trends that you're seeing we should be looking out for when it comes to the ownership economy that we should grab?
And thanks. I think one of the things which is slowly becoming apparent is that there has got to be a convergence of provision of services. You know, today, and if you look at most of the banks, perhaps we actually don't have these investment assets within our existing portfolio. So one of the things that we're going to see going forward is a convergence of things, i.e., banks and financial institutions will begin to host all these solutions under one umbrella. And that's significant because, and one of my favorite, supermarkets was Nakumatt Supermarket, and they said all under one roof. Because where we're moving to, we want all these solutions housed under sort of one application. I think that's something that we're going to see more and more coming along as we digitize and use technology to really power how people are going to interact with financial services. Yeah.
Okay, thank you. And last but not least, Anthony, when it comes to the real estate sector, what trends should we be looking out for in 2026?
So for real estate, I think the key game changer will be this structured, innovative financing options or ownership options for individuals. So I would urge people to be on the lookout at the D rates that will be listed very soon in the market. Look at those I-rate opportunities. What you'll find that for where we have had barriers before, probably access to very good real estate now will now be fractional to the tune of what we are calling $1,000 is like 100K Kenya shillings. Yeah. So even if you wanted to start with that sort of money, you might find that now you're accessing very good assets in the market. We'll continue to see a lot of trades in terms of demand for affordable to what we call mid-market housing, same to retail. Developers will stretch themselves. We'll see a lot of supply of between houses of 3 million to a maximum of 15 million there. But most importantly, because now the interest market has really stabilized, and we are seeing now interest moving to almost 10%. It means now cash flow availability to people will be high, which this is the time, if there was that plot you had benchmarked somewhere, or there was that asset that you wanted to take up, and you have some cash flow, which you can go to ABSA and take advantage of the available structures. I think capital availability will be better in the coming year, which will enhance liquidity and encourage people to do a lot of home ownership. Overall market, in terms of the big players, we expect to see a lot of development partnerships and joint ventures. I was just reading the other day, our banks are holding 1.7 trillion in their loan book in terms of real estate values. So you'll see a lot of collaboration between those big financial institutions with developers who can raise capital so that banks can be able to, maybe for non-performing loans, they can be able to almost securitize and liquidate those assets with partners that are credible. That's the sort of outlook that we foresee.
Okay, thank you. I'm sure there are questions around. So what you'll do, you'll continue to put them on your Slido, and I'm sure if you want any personalized answers, they are still around. So let's give a round of applause to our panelists. Thank you so much for that.